You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Does long-term investing guarantee investment success? I'm DeLegge with ETFguide. It's common for financial advisors to illustrate unrealistic long-term time horizons of, say, 100 or 200 years of stock market returns to prove that we should all be long-term investors. The problem with this argument is that it's completely irrelevant to you and to me. Think about it. Our present lifespans are not 100 or 200 years, and neither is our investment time horizon. I call this type of apples to oranges analysis the Jeremy Siegel syndrome. Another common habit is to categorize all investors, regardless of their age, regardless of their risk tolerance or needs, into one big group and to lecture them to be long-term investors, as if this is the solution to what ails their money. This type of negligent advice is tantamount to financial malpractice. The simple fact is people that are above age 50, 60, and 70 do not have the same investment time horizon as people that are 20, 30, and 40 years old. Most people at or near retirement do, in fact, have a much shorter investment time horizon and thus a higher need for investment income and portfolio liquidity. Moreover, older people have less time to recover from a significant market decline compared to younger people. Here's another uncomfortable truth. Wall Street's unsatisfactory performance is often shrouded behind its long-term investing pitch. For example, if you have a portfolio or a fund manager with lousy performance, just give it a few more years to get better. That's how many investment customers have been brainwashed to think. The bottom line is long-term investing in stocks, long-term investing in bonds, real estate, or whatever else is not the panacea for a misaligned investment portfolio. And telling a person whose portfolio is poorly constructed, clearly, or getting clobbered, to be a long-term investor and not to panic is brave advice, but not necessarily the right advice. Staying the course won't fix portfolios that are ignorant about cost, or ignorant about taxes, or ignorant about risk, or ignorant about diversification. In summary, I truly wish long-term investing could fix crazy people with self-destructive habits and architecturally unsound portfolios. But you know what? It will not. Go to PortfolioReportCard.com to get your investment portfolio analyzed and graded by me. And if you get an A, I pay you $100. I'm DeLegge with ETFguide. Thanks for watching.